Mr. Chairman, thank you for calling this hearing. I want to commend the City of Los Angeles, the OCC, and the CFPB for their actions, and the LA Times for bringing this to light. I was stunned when I learned of the breadth and the duration of the fraud committed by Wells Fargo. I hope today we can begin to understand what went wrong and what needs to be done. I call it fraud because I got tired of the euphemisms a long time ago. I think the American people did too. This is not a matter of customers who receive products and services they did not want or need, as Wells Fargo puts it. That makes it sound like there was a mix-up under the Christmas tree, and I got the right-handed baseball glove that was meant for my brother Charlie. This is 5,300 employees. Wells Fargo calls them team members. 5,300 team members forging signatures, stealing identities, Social Security numbers, and customers' hard-earned cash so as to hang on to their low-paying jobs and make money for the high-paid executives at Wells Fargo. And they did it for at least 5 years. Wells Fargo's reaction has been remarkable. It did not treat this as a big problem until it appeared in the newspapers. It did not begin to make customers whole until this year. And we don't know whether the bank chose to do so or was told they had to do so. Wells Fargo is taking out full-page ads claiming it is accountable and accepts responsibility. It has not admitted to responsibility for a single misdeed in the dealings with the City of Los Angeles and the federal government. Wells Fargo claims to have made things right with its customers, but its efforts have been incomplete. For example, it's not clear that PwC calculated the cost of a lower credit score, which might be paid every month for 30 years. At times, the bank has been downright hostile to aggrieved customers. Rather than letting fraud victims have their day in court, Wells Fargo forced customers to abide by the mandatory arbitration clauses in their real accounts. You heard that right. The bank invoked the fine print on a real account to block redress on a fake one, which Wells Fargo had created. Wells Fargo team members, many struggling to support a family on $12 or $15 an hour. My understanding is Wells Fargo tellers make about $11.80 an hour. Wells Fargo team members struggling to support a family on $12 to $15 an hour followed their manager's guidance to do whatever it took to make their quotas. Some may have worked off the clock. Others cut corners to avoid being fired for missing goals that Wells now admits were too high. They've been accountable, these low-income workers. The workers lost their jobs with no parachute of any color. And it's not just 5,300 team members who paid the price, because many more were fired when they couldn't meet the quotas. Still more chose to quit rather than cheat. By contrast, Ms. Carrie Tolstead, the Senior Executive Vice President for Community Banking, has done quite well. She knew of this problem at least 5 years ago and is retiring with a package that may be worth more than the CFPB's record fine of $100 million. So 5,300 team members earning perhaps $25,000, $30,000, $35,000 a year have lost their jobs, while Ms. Tolstead walks away with up to $120 million. Despite firing thousands of team members, Ms. Tolstead apparently decided it was not important enough to alert the head of the company, Mr. Stumpf, or the board of directors or anyone else for two years, if ever, even though you both sat on that bank's board. Senior management and the board of directors apparently agreed. Once the scandal became public, remedial actions were stepped up against frontline team members, but the praise and performance bonuses continued to be lavished upon Ms. Tolstead until as recently as 2 months ago. You would think the lessons of the financial crisis, which came at such a high cost to our country, would change the way the banks do business. And to be fair, many banks did take the lessons of the financial crisis to heart, but for the largest banks in this country, every week we hear of a new lawsuit or enforcement action against one of them, week after week after week after week. What are some of these lessons? First, the culture in these banks needs to change. That starts at the top. Second, there must be a reliable way for legitimate complaints to end up in the C-suite rather than the circular file. Third, in the wake of the rampant robo-signing fraud that we saw at Wells Fargo and other places, banks need better controls. Because fourth, if you pay people on the basis of how many products they sell, that's what they'll do, whether it's in the interests of the customers or not. And base pay needs to be increased. Finally, change the pay structure, or at least make incentives deferred, so it's clear that customer and company interests are aligned and enduring. Wells Fargo's come up short on all 5 counts. That conclusion is not just based on this, its latest scandal. Last year, Wells settled with the OCC for, among other things, 11 years' worth of deceptive practices in selling enhanced identity theft protection. So at the same time, think about this, at the same time the bank was stealing customer identities, it was charging for protecting them. If the Wells ID theft product that they sold didn't discover the fraudulent Wells accounts, perhaps some refunds are due. This April, Wells settled a False Claim Act suit for $1.2 billion, in part because it had used bonuses to get staff, quote, to churn out and approve an ever-increasing quantity of FHA loans, and applying pressure on loan officers and underwriters to originate and approve more and more FHA loans as quickly as possible, unquote. Thousands of Americans we know so well, although unfortunately far too few of us know any of these people personally, thousands of Americans lost their home through mortgage foreclosures as a result. So I hope, Mr. Stumpf, you will level with this committee and the public. Words that come like a San Francisco fog on little cat feet won't cut it. These were not magically delivered unwanted products. This was fraud that you did not find, or fraud that you did not fix quickly enough. Instead of focusing on damage control, you need to admit to the problems and fix them and treat your customers in real life like you do in your vision statement. That would be the best damage control of all for your customers, for your bank, for your industry, and for our country. Thank you.